Welcome to Trading Nation. I'm Seema Modi. Chinese internet stocks rallying Monday after e-commerce company JD.com topped quarterly projections. But U.S.-China tensions still looming for the group following a threat from President Trump earlier this week to ban Alibaba. How do you trade this uncertainty? Let's bring in Mark Tepper of Strategic Wealth Partners and Bill Baruch of Blue Line Capital. Mark, I'll start with you. If you take a look at the performance of emerging markets, China has been a standout. How do you trade these internet names?
So we like the internet names. I mean, when you think about all the noise that's out there, the U.S.-China tensions, they're not going away anytime soon. And in fact, I think it's probably possible that they get even worse. So look, what investors need to do is just tune out the noise related to some of these tensions and focus more on the underlying fundamentals of the companies. And if you think about where you want to be in U.S. stocks, Facebook, Google, Amazon, Microsoft, Apple, all those internet names, you want to be in the same space in China, in their internet names. And the virus has accelerated this digital transformation around the world, not just in the U.S. So for us, the best way to play this, we've got two different positions. The first one is KWEB, which is the China Internet ETF. Second one is Alibaba. So KWEB gets you good broad exposure with some of the biggest weightings being Alibaba, JD.com, Tencent. But if you want to play a specific name, BABA for us, that's our play on the growing middle class in China. Basically, you're getting all the businesses that Amazon has at a discount. You're getting e-commerce, cloud, Alipay, delivery. They're growing EBITDA faster than Amazon in a place with 4 times as many people with a slightly more attractive multiple. Now, the biggest risk right now is of them potentially being delisted. But I got to be honest, I don't even know the mechanics of how something like that could possibly happen, how it would work. It's one thing to ban an app that American children are using, like TikTok. It's another to delist a nearly $300 billion company that U.S. investors have their money invested in. So to me, that's more noise than anything. I'd be using those pullbacks opportunistically to buy. Yeah, that's a great point. We talk about how this could be a threat for U.S.-China trade tensions, the fact that Chinese companies could potentially be forced to delist, but the mechanism used to do that sort of hasn't been hashed out. Bill, what do you think, looking at Alibaba reporting earnings later this week, and the stock has had a nice run this year?
There's some great technical tailwinds here as well as fundamental. And one thing, too, China announced stimulus measures today, and the headline number has brought tailwinds. But even though that the actual net amount of stimulus added is much less, it's the willingness of the People's Bank of China to continue to aid the market along, to aid that economy along. Last week, some poor data, and ultimately they're there as a backstop. So that's helping the market here today, as well as those earnings from JD. But looking at the stock on a charting basis here in the near term, BABA broke out above a trend line, a rising trend line that is, and that now brings support at 240. It's consolidating very healthy up there. So you really got to be along this name out above 240, targeting about 290, which isn't that much higher, but it should be achieved. And then you have a backstop of support, really big support down at 230. So you can really trade that name looking at those two support levels to manage your risk. And then JD did move out above the 50-day or held the 50-day moving average and is holding out above there very well with strong support well below at 55, 56. So there's some great backstops technically, but also that fundamental one that China is going to continue to aid that economy along.
Mark, last question. When looking at emerging markets, China, would that be your top position? Or are you starting to look at other markets like India that you have seen has been one of the beneficiaries as more companies try to diversify their supply chain outside China?
So within emerging markets, I mean, we always have to hold a percentage in emerging markets for all of our clients. It just makes sense from an asset allocation standpoint. China is the #1 place we want to be in emerging markets right now because of that rapidly growing middle class. That's a trend we want to play. So China's our favorite.
All right. Mark and Bill, thanks for joining us today.